We're looking at the Chapter 17 PowerPoint, and now we're just going to talk about some things, and like with other areas, we won't go in depth on all of these, but just to let you know what's out there, especially if you specialize in certain tax areas. One thing you may be familiar with, or when you start saving for somebody else's education, you may be familiar with, and this is tax subsidies for education. So one thing you might have is an EE savings bond. Right, so these are things that encourage you to save for education. They give you some certain benefits because in their mind you're doing, I guess, a good thing by saving for education. You notice it says there's an above the line deduction for interest on qualified education loans. Right, so if you have a student loan, you can get an above the line qualified education deduction for the interest. Then it says above the line deduction for qualified education tuition and fees. Right, so these are actually going to be these next items, which are the American Opportunity Credit. You either can take an American Opportunity Credit, you can take a Lifetime Learning Credit if you don't qualify for the American Opportunity Credit. They also talk about the idea of qualified tuition or 529 programs. And then there's a Coverdell Education Savings Account. So both of those are just um, incentives they've kind of put together to encourage you to once again save for education, which at least currently we think is a good thing for you to do. All right, so let's look at casualty losses. Right, so this is something that used to be a lot more general in what it applied to. So again, it got changed and did not change for the, I guess, more ability to use. It got changed to for you are less likely to be able to use it. Because you used to be able to use it for things such as theft or vandalism, things of that nature. Now, as it says here, a casualty is a loss and it must be attributable to federally declared disasters. Right, so that greatly limits it, as you can imagine. The loss is going to be equal to the lesser of the adjusted basis or decline in fair market value of property. The loss is reduced by insurance reimbursement. Right, so if you get reimbursed by your insurance, this casualty loss is going to be less. Right, be careful. If you're getting a full reimbursement, it's better to get the insurance reimbursement than it is this loss. So don't complain if you get that full insurance reimbursement. And here's something that's interesting. I cannot tell you why they have this, what they call a floor in here, but the only amount of loss in excess of a $100 floor, and this is important, per casualty is deductible. Right, so again, it probably don't mean as much now because if it's a federally declared disaster, hopefully you don't have more than one flood in a year, more than one tornado in a year. But if you did, then for each of the losses for those events, you'd first have to adjust it for $100 for this floor, and then base the casualty loss on the rest of it. Right, again, that's where we get way too complicated, in my opinion. Okay, and then it mentions here, so once we do the $100 floor, we also need to make sure that we reduce it and limit it to that's over 10% of our adjusted gross income. Right, in their mind, we can, if it's less than 10% of our AGI, we really could pay for it and don't need assistance. That's basically what it's saying. If it's over 10% of our adjusted gross income, then they may need to look at helping us with that or letting us have some kind of payback in a way, at least to a certain amount. Okay, then we turn to hobby and gambling losses. So activity not entered into for profit or a hobby, you say, well, that means I don't have to do anything, right? Well, no. What they're saying is if it's a hobby, the revenue must be included in gross income. If you have expenses, they're not deductible. Right, so it's actually worse than having a business because your business, right, you're going to have your income, but you're going to be able to offset it by business-related expenses. If it's considered a hobby, it's going to include your gross income, but you don't get the expenses to deduct. So you can imagine there's a lot of argument back and forth at times between the IRS and the taxpayers about is something a business or is it a hobby? And it mentions here one of the things they might look at is if activity generates a profit in 3 or 5 years, the IRS presumes it's a business. That's not always, especially in times of recession or pandemic periods, that you can't really go by that. But they look at a lot of things. You need to try to be able to justify why you're treating business income and expenses like business income and expenses, and not just that it's really just a hobby. And it mentions here the net loss is deductible above the line if you have a Schedule C business. So again, you can take some and offset if you have, and we'll look at that with the problem. See, you need to make sure you have money at risk or something of that nature is how they term it. But we'll kind of look at that. Make sure it's actually something you have the risk of losing money on, in other words. Okay, the other side of that is gambling. So winnings included in your gross income. So if you win gambling, you do include the winnings. You can take losses as an itemized deduction. However, remember, if you're not itemizing, you're not going to get the benefit of it. So in other words, you're not going to take your losses in the same place as you are your gross income. So it's not always going to be a dollar for dollar offset. And then the other thing you need to keep in mind is even before you look at the percent you're going to be able to take, your losses are limited to the amount of gambling winnings. So if I, am the daily gambler, and I get lucky and I win $25,000, that sounds good. I've worked with clients who did stuff like that, but then they also kept track of their gambling losses, and so they're happy they won $25,000. But you look and they lost like 58,000 or 60,000, right? So it's saying of those losses, you can take up to that $25,000 as an itemized deduction, right? So hopefully you can itemize and get that benefit. But if you can't, so it's not always offsetting income, in other words. And again, we'll look at an example or two of that when we work through our problems. Then they look at home mortgage interest. So this is qualified residence interest, and it's an itemized deduction. Interest is on the acquisition debt. So a couple of things you can get, maybe you purchased a house or you built it. So the interest incurred to acquire, construct, or substantially improve a personal residence, that's acquisition debt. And it must be secured by the residents. And most of the time, that's what it's going to be. The acquisition debt is limited to $1 million for debt incurred on or before December 15, 2017. So that's when one of the tax acts were placed in there. And again, after that, that limit actually got reduced to $750,000 for debt incurred after December 15, 2017. The deduction for debt on the principal residence is okay. So if you have one property and that's your principal residence, you can deduct the mortgage interest for that. If you have one vacation house, that's your second residence, and you don't rent it out or treat it as a rental property, that's going to be another one you can take mortgage interest on. But let's say I have two more, maybe I inherited properties, and it's just saying if I were to happen to have mortgage interest on those properties, only one principal and one other. So the other two would not be able to count toward my mortgage interest. Odd thing is you can count it towards your property taxes if you pay property taxes on it. Then they mention the idea of a vacation home rental. I mentioned, sometimes you'll have a second residence and you'll rent it out. So residence is subject to vacation home rules. So if the owner's days of personal use exceed greater of 14 days or 10% of rental days, right, that's when you're going to have a rental property, but you're going to have to make sure you treat some of it as personal use. I think we look at one of those, but if not, that's kind of a specialty area if you work with individuals. And it mentions here the expenses attributable to rental days are deductible to the extent of rental revenues. Right, so you basically, don't get greedy. Only use the expenses related to the part of it that you're renting out, or the days you're renting out. It says vacation home rental can't generate a net loss deductible against other income. So, right, vacation home. That's not saying any of your rental properties, right? That's vacation home. If you have a rental property that you rent out all the time, that's something completely different. And it mentions if you do have that vacation home, non-deductible losses do carry forward. Well, let's say we sell a residence And in particular, well, I guess we should mention the other side. If you sell a residence and it's not considered your principal residence, then this doesn't apply. You have to report the gain or loss if it's treated as an investment. So there can be good or bad about that. However, we're going to look here because there is an exclusion about the gain on the sale of the principal residence. Right? In general, unless it's in recession year, right, real property goes up in value. So most of the time when you sell, you're going to have a gain of some kind. So if it is your principal residence, if you are single, you can exclude, so you're going to calculate the gain, and you can exclude $250,000 of that gain, or up to $250,000 of that gain. If you're married filing jointly, you'll be able to exclude up to $500,000 of that gain. Right, but here's the key. The owner must have used the home as principal residence for 2 out of the 5 years ending on the date of the sale. Right, so they give you some time here between, I guess, if you're moving and you still need to sell, it gives you some, I guess, generous time period. But of the 5 years, if you've lived in it 2 out of the last 5, that counts as your principal residence and you're selling it. And I think there is a limit. You have to wait a couple of years, I think. I can't remember the exact years, before you use this exclusion again. It says the exclusion applies to only one, oh, here it is, only one sale in a 2-year period, right? So they don't want you to move and then do it again. But if you think about it, to qualify as a principal residence, you need to live in it for 2 years. So you're going to meet that exception or that requirement anyway. And we'll look at that. There's a problem we're going to work out that if you don't stay the full 2 years, but I think our example was you had to move for your job. So there are some qualifying things that says, okay, you probably would have stayed here if you didn't have to move for your job. You don't get the whole credit or the whole gain exclusion, but you will get a formula to use, and you get a certain percent of it. So at least they try to help you a little bit with that. But it has to be for what they consider a qualified reason. And then the gain on the sale of the principal residence. The owners who sell a home but can't satisfy the above requirements, this is what I just talked about, may be eligible for reduced exclusion, change of employments when I've used it. Health reasons could be a reason, or unforeseen circumstances, right? So there's some ambiguity there, but I would do some looking at, and it didn't just Scott decided, I don't know, that he doesn't want to live here. It needs to be something more concrete than that. There needs to be a reason that I need to leave. All right, so this just introduces to the rest of the kind of information that is in chapter 17.